Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is about the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil, and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only. Doesn't take your personal situation into account. With all that said, let's get into our first chart. So we'll start with the S&P 500. And we have yet another new all-time high on Thursday. And it's really not any great surprise to see this, because the way all-time highs often work is that they tend to cluster, and you'll get a series of them within a space of time, and that's just often the case when the market is running. We often see these series of all-time highs develop, as has been the case over the last few weeks. And the message remains the same as last week. And that said, the message remains the same for the last few weeks or few months, really, and that is let profits run. The path of least resistance at this time, it really does remain to the upside. And this is one of the things to remember. While the rally does look extended by all descriptions, it hasn't touched the 50-day moving average since all the way back in November. It is getting stretched above the 50 and the 100-day averages. So whilst those things, they're risk factors that we need to consider, the important thing to remember is that these situations can persist for longer than many people think possible. So this is why I say the strategy when you have a strong rising market, it's stay with the trend, let profits run. And as I've said before, I think one of the biggest mistakes that people make, that investors make, traders make, they try to pick the top. They try to pick the top, and they will invariably end up getting out too early almost all of the time. And I think the best we can do in these situations, it's, as I keep saying, it's let those profits run and then use a trailing stop that travels beneath the market to limit your downside when you do get the inevitable turning point. If that turn is deep enough to hit your trailing stop, that's what protects your downside. And saying that, I'm less enthusiastic about buying stocks at these levels, or buying the index in particular, I should say. I'm less enthusiastic about buying the S&P 500 as a brand new entry. It just doesn't seem like an asymmetric point to be bringing new money into the index at this time. And I also don't want to chase stocks that have run hard. And when you look through the various stocks on the market, there are a number which have run really hard over the last month or so. We're always balancing risk. That's what this investing and trading game is all about. We're balancing risk. So as I say, we want to let those profits run, but we also want to make sure that the risk reward stacks up when we're considering a new position. It's like, is the risk I need to take to get potential upside, is it acceptable given what my upside could be? That's what we've got to consider. I'd rather be looking for opportunities from within the S&P 500 at this point, rather than coming in and buying the index outright after it's been rallying for 3 or so months now. On that point, what's interesting to look at, let's just quickly look at the S&P 500 equal weight. This is an ETF. It's an equal weight ETF. It hit a new high on Thursday as well. And what's interesting about this is that it had been lagging through much of December, January, into February. It had really been lagging, hadn't been running with the S&P 500, and it's now gaining momentum. And just compressing this a bit, you can see the previous all-time high from December 21. We're now above that, and we're seeing the market lift off out of this consolidation that had taken place over a couple of months. We're lifting out of that. So what this tells me is that the rally that we're seeing now in the S&P 500, it's not just a narrow rally led by the big seven. It's what we often hear about in the media. It's the big seven, the magnificent seven. They're the ones which are causing this rally. And yes, they're a big big component of it, but they're not the only component. When you see the equal weight also breaking and hitting new highs, it's a good sign that there's market breadth, which is also behind the rally. So of course, this doesn't guarantee stocks will keep rising, but it does remove, at least what I think it removes one of those arguments we hear the bears talk about, that you should avoid the stock market because it's only a few big companies which are driving the gains. I think the equal weight index suggests otherwise. Now, if you're getting some value from this, please hit that like button, leave a short comment, just hey, thanks for the video. Helps me a lot, means YouTube will show more people. Hit that subscribe button if you haven't already done so as well. Now, let's move across and have a look at the small caps. Let's have a look at the Russell 2000. And so it during the week, it hit its highest level since April 2022. So let me just compress this. You've got to come back here. April 2022 was the last time that the Russell was up at these current levels. So it's the highest level in nearly 2 years. And the rally also takes it through this resistance band. And so this covers the highs we've had in 22 and through 2023. We got a brief breakthrough in December, quickly came back beneath, and now we do have a more sustained break just in the last couple of weeks. I think from a risk reward perspective, I think the dynamics of this segment of the market, I think they're the most appealing when you break it all down and look at it. The index is coming off a relatively low level. We just compress this again. You can see the big decline we had during 21, 22, this big basing structure. So we're in the relatively early stages of lifting off that base. That's why I say it's at a relatively low level compared to the SP 500. It looks like it's starting to lift off. So yeah, is this big platform which has been developed over a couple of years? It looks like we're starting to lift off that now. One of the things I like about this chart is that it looks like there's been accumulation on pullbacks. And this is something I've spoken about in recent weeks, just looking at the 50-day moving average. Each time it's come back and tested it, we've got a quick snapback rally. So for me, that indicates there's buying interest on the pullbacks, which is a different dynamic to what we've seen in previous times that the market's tried to rally. And as I said, from a risk reward play, I think this is the smaller stocks are the most interesting segment of the market as it stands at the moment. So look, let's leave that there today. Thank you for joining me. Hopefully that's been interesting, and I look forward to coming back talking to you again next week. Till then, bye for now.